All right, good afternoon, good evening, everyone. This is Charles Barfield, OCEA's General Manager, coming to you from OCEA's headquarters here in North Ross Street. First of all, I just want to thank everyone for joining us via Zoom for this very important educational meeting regarding our tentative agreement. We had an in-person meeting yesterday under the building. And if the composition of the folks on this Zoom is anywhere close to that showed up yesterday, I'm going to go out on a limb and say most of the folks are long service county employees, maybe a few retirees, but everyone definitely interested in how does this tentative agreement affect me and what are the choices that are coming up. So again, I know that the recording popped up, but I just want to remind everyone we are recording this. And the reason we're recording this is we're going to post it on our website so that folks who go to our website during ratification, if you want to view this and review it if needed, because this content is pretty complex, then it'll be available for all members before they vote. So we are going to keep the chat closed during the presentation. Just for limiting distractions. I will be going through not a long PowerPoint, but a very detailed one. And once we go through that, we will open up the chat and the lines for questions. There'll be plenty of time for that. So let's wait till we get to the end before we handle questions. So obviously, you know that last week we announced a tentative agreement because you're on this call, and we appreciate you taking the time to learn more about these two items. What we're going to be discussing tonight is simply two items, and that is the restructuring of the current retiree medical grant program, as well as some vacation cash out and usage enhancements. Now, if you've read the tentative agreement, you know that these are the only two items in it. No other MOU provisions are changing. Now, for these provisions to go into effect, there are two actions that are required. Number one, it requires ratification by the membership. And that's what this is designed to do, to educate the members before we open up voting. And secondly, if the members of each bargaining unit do ratify the tentative agreement, then it goes to the Board of Supervisors for adoption. And we know that that's already scheduled for December the 20th. Now, if this agreement is not ratified, then no changes whatsoever to each of our 6 bargaining unit MOUs. As you know, we're currently in a contract until the end of June. And the other important thing to know that if this is ratified and adopted, it has absolutely no impact on our upcoming negotiations. Any cost to the county associated with these changes has been specifically agreed to that will not be a part of the upcoming negotiations. And that was an important part for our bargaining team. Okay, I do want to address 3 common questions before we actually get into the deck, because once we announce the tentative agreement, we get email responses, we have phone calls that we've been triaging, and we had our in-person meeting yesterday. One of the most common questions is, if I'm a current retiree, which means I've already left service, how does this affect me, if at all? And the answer is, it does not affect you. If you've retired, meaning you've left service, then the provisions that existed at the time you made that choice is what's in effect. These potential changes are prospective. They are in the future. So it doesn't affect you if you're a current retiree. Second question, I think I'm going to retire in March. How do these changes affect me or impact me? Well, if you go in March, which means you retire, you leave service in March, anticipating a pretty good COLA, these changes will not affect you because your decision to leave service predates a key date, and that key date is June 16th, 2023. And I'll keep referencing that date because that's the date of a transition. Now, before we get into the details, if you leave service anytime before June 16th, 2023, then it's the current grant provisions that prevail. Anytime after June 16th, the new choices will be in effect, and we will spend time contrasting and comparing those two choices. So what is immediately at hand? And that's ratification. This is part of our ratification process where we go out and educate the members, open up voting, give members and only members the opportunity to vote. If you're a non-member, you don't have a voice in this union as it relates to setting priorities, and you don't have a vote when it comes to ratifying a contract or a tentative agreement like this. So we will distinguish between the immediate timeline, which is about ratification, and then a transition outline if this is ratified, and most of that is going to be later in the spring as we approach May and the effective date of June 16th. So let's get into it. Now I'm going to screen share a PowerPoint, and I will be on screen, but I will walk through this PowerPoint with you, and I will just tell you that there you. So guess what? Every little mistake I make is also going to be recorded. So, so the two components, we have the retiree medical grant transition to a health reimbursement arrangement, better known as an HRA. And then secondly, vacation usage and cash out enhancements. Now, the vacation usage and cash out, if it's adopted, go into effect immediately, but the potential transition to an HRA will go into effect June 16th, 2023. Sorry, Kevin, this is not advancing. Okay. Is that a right button? Okay, thank you. Okay, why change the retiree medical grant? Great question. Number one is we know that the grant in its current form does not work for a majority of workers. And we're going to spend some time talking about the limitations and permitted uses for the grant money. Second, I don't think anyone would disagree that addressing healthcare costs, particularly in retirement, is a major concern for OCEA members. Thirdly, and you will see as we get into this, workers want a choice. And in this case, there's going to be a choice in how you use retiree healthcare dollars. And no one will get forced into a different plan. If it makes sense for you individually to maintain the status quo in the grant, you will have that choice, or you'll have another choice, and candidly, we think that that is a better choice. And lastly, again, immediately, the first question is a yes or a no to ratify this tentative agreement. If each bargaining unit votes yes to ratify, then we will go into an education transition on the two choices, and your individual choice will come later in the spring, probably in the April or May timeframe, which if people are contemplating an early 2023 retirement, they will have plenty of time to evaluate what is in their best interest. Retire before June 16th under the current grant, or elect one of the other two choices and leave service after June 16th, 2023. And then lastly, several other Orange County unions have transitioned into an HRA model, but not with the terms that we have negotiated with the county. And then lastly, our board, many of you know that we've been talking to the county about this since 2019. Our board, our stewards, our members have waited patiently for a superior benefit, and now it is included in this tentative agreement. So tonight, we will talk about what is the current retiree medical grant, call it the RMG. What are the limitations and usage for the grant money? What is a health reimbursement arrangement? For a lot of you, maybe tonight is the first time you've ever heard those words. And what is an HRA? We will break down the tentative agreement components. We'll talk voting timelines. And then again, what are the immediate actions and then the transition actions that will be coming later in the spring. So we're going to pause here just for a moment and unpack the current retiree medical grant. The first thing to know is that the grant is not a vested benefit. The grant has been in place for a number of years. It is unlike your retirement. When you are vested for your retirement, vested means you're entitled to it and it cannot be taken away. The retiree medical grant is not vested. None of us believe that the county would walk away from this, call it an obligation or a moral obligation to continue the grant. But if one day the county decided to cease that benefit, then all the participants would not have any claim or right to any of the assets. It's not vested. It is, however, 100% county funded. Today, the county spends about $55 million a year funding the grant. And you have two populations. You have the current retirees that are currently receiving grant benefits. And then you have active participants who one day may begin to draw benefits out of the grant. Currently, county workers do not contribute. It is 100% county funded. And what we're going to show you going forward is also 100% county funded. The structure of the retiree medical grant is that it provides a monthly grant amount of $25.37. Now, this amount is the 2023 amount. 2022 is a little bit less. I think it's $24.86. But for the sake of this illustration, we wanted to show you 2023's amount. $25.37 for each full year of service after 10 years of service. What that means is anybody with less than 10 years of service has absolutely no financial stake in the grant. You don't earn any financial stake until you have a full 10 years of service. Now, interestingly, 50% of the county workforce today has less than 10 years of service, or 10 years or less, meaning 50% of the active employees today have no financial stake in the grant. The current grant is capped at 25 years. Now, I saw a name on the waiting list or the waiting room list, and I know this person has 30 years of service. But if this person retires with the grant, the max that they can get is 25 years at $25.37 a month. There's no value of any year of service beyond 25. The current grant includes age-based adjustments. Now, what does that mean? The way the grant is structured, The full retirement age is age 60. For any year that a county employee retires earlier than age 60, there's a 7.5% reduction. So if you retired 2 years early at age 58, there would be a 15% reduction to your grant amount. Conversely, beyond 60, for every year after age 60, you add 7.5%. So if you went at 62, your grant amount based on your years of service up to 25 plus 15% up to age 65. Then, no matter when you retired and started taking your grant, it gets reduced by 50% at age 65 Medicare eligible age. Now, this is key, and this is why, in part, more than 20% of county retirees walk away from the grant, walk away from their money, because the grant money can only be used to offset county retiree health plan premiums and Medicare premiums. So many of you know that county retirees, many of which choose to move out of the area. Every retiree plan that the county offers, except for one, are HMOs that operate and are licensed to operate in the state of California. The PPO option, you can go anywhere, but it's a little expensive. So fundamentally, 0 to 10 years, you have no interest in the grant. After 25 years of service, you're not getting any credited time for your service. And then lastly, more than 20% actually walk away from the money. So that told us fundamentally that the grant needed to be restructured. Now here's a couple of repeats, but again, 0 to 10, no financial stake in the grant. Years of service are capped at 25. Linked, which means to access that money, you have to enroll in a county retiree health plan. With one exception, I want to make sure that I don't forget this. Beginning in January 1st of 2022, a new provision went into effect for retirees that retired after January 1 of 22. And that is, if you have health care from another source, a spouse, for example, you can temporarily opt out of any county health plan, not take your grant money, but preserve the ability to opt back in during an open enrollment and qualifying life event. Okay, so I just wanted to make sure I mentioned that. It's not portable, meaning that you can only use this grant money for those two purposes: Medicare premiums and county health plan premiums. Oh, there it is. There's the stat. 20% of retirees do not participate, leaving money on the table that the county has set aside. So now let's walk through what a health reimbursement arrangement is and what the advantages are. With the HRA that we've negotiated with the county, all years of service will be credited with dollars and no caps. Now that's once you have achieved 1 year of service. So let me restate that. As long as you have 1 full year of service, or to 50, or to whatever, more than 50, all years of service will be credited. Secondly, it's 100% vested, not 0% vested. It's 100% vested from the very minute your dollars are deposited into your account. Your account, not the county, not grant assets, but an individual HRA account that when you leave service, it doesn't have to be retirement. If you are terminated, you voluntarily resign, as long as you have more than 1 year of service, you have dollars that are 100% vested in your account, you take it with you. There are no adjustments for early retirement because an HRA is the accumulation of money over time with a designated purpose, i.e., to reimburse yourself with out-of-pocket medical expenses. Portability, it's not limited like the grant. It's your money, you take it with you. So let me use an example. If you're on this call right now, you have 8 years of service. You have zero financial interest in the grant. However, if you left service tomorrow, you would have 8 years times $855 per year that is in your account, and you would take it with you. That is a fundamental difference between the current grant and an HRA. An HRA is derived from the IRS code. Like a 401k, like a 457, an HRA is specific out of the IRS code, specifically designed to reimburse you for out-of-pocket expenses. And then what we've also negotiated is a 2.5% increase in the county's contribution every year in perpetuity. And we'll get to more specific details as to what that means. Your choice, your money. Again, the effective date is June 16th, 2023. Every employee who has not left service will get a choice. And that choice is to freeze the grant or contribute the cash value into your HRA account. And this is modeled after the county's VIP program in 2020. Remember, one of the choices that potential retirees had was a complete cash out of the grant. And about 23% of the folks chose that option. And what that said to the county was, there's some interest there. So again, all full years of service after 1 year are recognized or credited in either case, whether you choose to freeze the grant or to cash out of the grant. And everyone under this scenario gets more, almost. And that almost is the few people that have been hired in the last year who have not accomplished a full year of service yet. You're still in that eligibility period of 1 full year of service. I said everybody gets more almost because that's status quo to the grant, but everyone with 1 year of service or more, there's more. Okay, now let's unpack this even a little bit more. If you choose to freeze the grant, remember, you're going to make this choice before the effective date of June 16th. That means all full years of service are frozen at the current grant amount up to 25 years of service, just like the grant. Okay, if you have less than 25 and you choose to freeze, you will be freezing your full years of service at the 2023 grant amount. But no, there is no future growth. It's frozen. There's no age-based adjustments. So given your age, if you freeze the grant, there's no 7.5% reductions per year, but there's no 7.5% adjustments up each year. However, the one adjustment that remains is that it is reduced by 50% at age 65. But wait a minute, what about those years after 25? If you freeze the grant, you will freeze up to 25 at the grant amount. Any year of service beyond 25, you will get credited into your individual HRA account at $855 per year. Given the example of the 30-year employee, if that person freezes the grant, they would freeze 25 years in the grant, subject to the grant's limitations and uses, which means that you can only use that money for a county health plan premium or Medicare premium. But the 5 extra years at $855 a year gets credited into an HRA account, which means that you have both. You have the grant with its uses and the HRA with its flexible portable uses and that reimbursement provision. But there's more. That doesn't mean anybody has to retire on June 16th. Most people won't, right? They will continue their service. So moving forward, beginning June 16th, the county will contribute $60 a pay period into your individual HRA account. And that will continue until July of next year. It'll go up 2.5%. July of 25, it'll go up another 2.5%. And then another 2.5%. So these aren't earnings within your account. These are increases in contribution from the county into your individual account. HRAs, based on their definition, money goes in tax-free, which is from the county. You don't contribute anything. It is tax deferred. Any growth within your account is tax deferred and self-directed, just like your 457. And in the case of the HRA, when you are ready to take money out, it comes out to you tax-free. Tax-free in, tax-deferred growth, self-directed, and tax-free distribution. It is your account. It is your money. So that's one option, to freeze the grant. Now, the second option is to roll over, cash out the cash value of the grant into your HRA. All full years of service at the effective date, which is June 16th, will be credited to your HRA account at $855 a year. Whether you have 1 year, whether you have 10 years, whether you have 30 years. So if that 30-year member that I saw earlier says, I don't want any part of the grant, I want to cash that out, 30 years times $855 a year will go into his or her account, no cap applied. So I know I've said this several times. Any employee with years of service of 1 to 10 see immediate value that doesn't exist today, but post-effective date will. And again, here I cite an 8-year employee. If they left service after the effective date, they would have $6,840 in their HRA account. I think earlier I said if they left service tomorrow. That wasn't true. You have to get past the effective date of the transition. But again, if you cash out, then future service contributions into your HRA account begin at $60 a pay period. And again, you have the 2% increase in contribution growth each year. Now, let me show you the power of that escalating contribution. So it begins June 16th, 2023 at $60 a pay period, which equals $1,560 a year. In 5 years, that 2.5% escalator will grow to $67.88 a pay period, or $1,765 a year. And the cumulative effect of that is the contribution has now grown by 13.13%. But wait, after 10 years, what does it look like? After 10 years of escalating contribution, your pay period contribution would be $76.80 or $1,997 a year. And again, that cumulative effect of year over year is now 28.02%. Okay, I trust that that's a lot of information for some of you. And we'll open up for Q&A in just a few minutes. But I also wanted to highlight 3 enhancements regarding vacation cash out and usage, which we've negotiated with the county. After having gone through the last 3 years or so with both AL cash outs and vacation, and candidly, a number of folks had hit the vacation cap due to a number of factors that all contribute to that. But we've negotiated 3 workarounds. The first one is, and again, as you think about this, these go into effect immediately upon adoption, which means after December the 20th, if it's adopted. This does not wait until June 16th of 2023. So all of the rules regarding vacation cash out under the previous provisions are no longer applicable if it's adopted by the board. So employees with 80 or more hours of annual leave shall be allowed an additional 20 hours of cash out upon request for a total of 100 if they will reach their vacation cap during the fiscal year. So as you approach the beginning of a fiscal year, if it's projected, you don't have to be at your cap. It just has to be projected that you will hit your cap based on your vacation accruals sometime during that fiscal year. And if that's the case, you are afforded a vacation cash out up to 100 hours anytime during that fiscal year. There's another enhancement. Previously, employees with 10 or more years of service could use vacation, 40 hours of vacation, if they still had any AL hours on the books. So now that's modified. The years of service are gone. It is simply any employee with 80 or more hours of annual leave, you can use up to 60 hours of vacation during the fiscal year. Now, these 80 hours are not just plucked out of the sky. Looking at the balances that still exist on the all OCEA represented classes, 80 is an important number. There's still a lot of folks who have AL on the books. What we wanted to do, and what we think this does do, by adding 100 cash out and 60 being able to use it for the vast majority of OCEA members, that's your vacation accrual. And you'll be able to use these 2 provisions in order to work around not hitting the vacation cap. But there's another one, and this one is applicable in our supervisory management MOU. And these are the classifications that currently have a cash out cap of 120 hours. So if within that bargaining unit, employees with 80 or more hours of annual leave shall be able to cash out 120 hours of vacation. And it can be only vacation. That's different than the current provision. And this was intended to, again, provide those folks with that additional tool requesting cash out of vacation alone up to 120 hours if you so choose, or any combination of vacation and annual leave up to 120 hours. This is going to help a lot of folks, and we wanted to do that for them, and we wanted that to be effective immediately, which we were able to get. So, taking a breather, now let's talk about next steps. First of all, as I said earlier, we do member education. And tomorrow, if you are talking to your coworkers or any coworker and they're saying, I still don't understand what's happening with this HRA business, direct them to the Zoom meeting tomorrow at noon. We will be doing this again tomorrow at noon. If you need to talk to an OCEA staff member, just like in contract negotiations, we offer up multiple staff members to answer member questions about this transition, and we continue to field those today. Lastly, as part of the announcement, we put together some comparison charts. So please use all of that information to get as educated as you possibly can about these changes. Oh, there they are. There's the FAQs and charts. Oh, there's OCEA staff. I pay attention to my own PowerPoint. Okay, now voting. So we're going to do the Zoom meeting tomorrow from noon to 1. At 1 o'clock tomorrow, we will open up our third-party vendor who conducts our online elections. So at 1 o'clock tomorrow, members will be able to sign on and vote. And as you guys know, thousands of folks vote on our contracts. It takes about 30 seconds. When you sign in, your membership is verified, and then you simply click, I accept this agreement or I reject this agreement. The online voting is going to be open through December 15th at noon. Paper ballots, as usual, are available here. If you'd like to come in and vote using a paper ballot. Oops. After the 15th at noon, when voting closes, we will then certify those votes and those results. We certify those results by bargaining unit. We have 6 individual bargaining units, so all votes are tallied by bargaining unit to determine whether or not each bargaining unit ratifies the changes. If any unit that ratifies, then it will go to the Board of Supervisors for adoption on December the 20th. And we certainly believe that it will be adopted. After adoption, between January and May, you can expect the county to provide resources, education, internal resources, county benefits staff. They are currently building a portal where, and I just see Salvador Melgar's name on the thing, so I'll use him as an example, is Salvador will be able to go to a portal, verify his ID, and boom, it'll pop up a comparison of Salvador's choices between freezing the grant and cashing out the HRA. It's that personalized. That's the primary way that the county educated folks back in VIP, and they intend to use that same kind of strategy this time. I'm estimating in May that the transition window will be open to make your choice because it has to be in place by June the 16th. So I'm just surmising that around May will be the deadline for everyone to make their choice. Again, the effective date is June the 16th of 2023. And then future service contributions began that pay period, June 16th, 2023. So with that, Kevin is going to monitor the chat in regard to questions. Again, I would simply ask you beyond this that you get the resource materials in front of you. I talked to somebody today who had never heard of what the grant was, and he had worked for the county for close to 20 years. So I get that this is new information for a number of you. I saw a couple of quick chats pop up. I think one of the questions was, what are the investment vehicles within the HRA? Similar to your 457, you will have a suite of options. Everything from stable value, which is just that, stable value, probably in the percent and a half return range, up to equity-based or mutual fund-based funds. So it does range a spectrum. You'll have a spectrum of choices. I think the last time that I looked, there were about 10 different choices. The other question I saw pop up was, who administers the HRA? It is the county already has a contract with an administrator called ICMA, and the other represented groups who have an HRA, they use ICMA as the administrator. Okay, we saw that. Is there an opt-out time frame or deadline? The deadline is going to be June the 16th, or it may be slightly before that. And so leading up to that, Zena, is going to be, we will educate everyone, and each participant will have the choice to freeze the grant or go the HRA. So your reference to opt-out, the only opt-out choice is to completely opt out of the HRA and roll that money, opt out of the grant and roll that money over to the HRA. A deadline, it's going to be shortly before June 16th or 2023. So then that begs the question, wait a minute, I've got this retirement decision I got to make, and that's not fair. You're forcing me to make this decision. Well, there has to be an effective date, and it's black and white. You either retire or separate before the date or after the date. So wait a minute, CB, you're going to force me to make this decision. How do I know what is best for me? Well, you're the only one who's going to be able to figure that out, because you have to factor in your age. You have to factor in when you want to retire or separate service. You need to factor in your lifestyle, your healthcare needs, how long you're going to live, where you're going to live. All of those variables only you can answer. So we have fielded that question for many people. Tell me what's the best choice. It is the best choice for you when you are looking at the numbers. Okay, Eric, as explained, this is not an all or nothing, but where each unit choosing to adopt or reject. That's a great question. Okay, so when it comes to ratifying each bargaining unit, so we have 6, each of those bargaining units initially will be voting to ratify or not. If it's ratified, the changes go to the board for adoption. If it's not ratified, it does not. Is it possible that 1 out of the 6 bargaining units doesn't ratify? Sure, it is possible. So it's not an all or nothing, but it is an all or nothing within that bargaining unit. So if your bargaining unit accepts it, it's applicable for everybody in the bargaining unit. If the bargaining unit doesn't accept it, then it's rejected for everybody in the bargaining unit. That's why we are focused first on the ratification choice, which is yes or no. Then for any group that is ratified and adopted, then we're talking about transition. Then your choice on an individual basis is, do I want, if I'm still in county service, do I want to freeze the grant or do I want to cash out of the grant and move those assets to an HRA? Does the employer contribution to an HRA continue into retirement or stop once employee retires? Thank you, John. That's come up before. Those contributions stop when you leave service, whether that's a retirement, leaving service, or whether that is just leaving county service. You resign and leave service. When you stop service, regardless of the type, contributions will stop. Mary R., why the push to vote the next day? Okay, well, it's not a push to vote the next day. We announced this last week, and we created a window, about an 8-day window. So you don't have to vote the next day, just that's when it opens. So if you want to take the time, those 8 days, to learn as much as you can, you have until noon on December the 15th to vote. And that's what a lot of people do. Some people go in immediately, some on their leisure, they learn about the tentative agreement and anything associated with it, and then go in at their convenience to vote. And that's why online voting is so convenient. So Mary, if I didn't answer that the way the question was intended, please drop another chat in there. But again, the voting window is an 8-day window. Kevin, how are we doing on other questions, or am I seeing them all on the board? Okay. So everything I believe that's been thrown into the chat, we have addressed. Okay, Demian says, are employee contributions an option to boost their personal account? Okay, we're gonna unpack HRAs just for a moment. The one thing about an HRA for a unit is that everybody has to be treated the same under the IRS rules. So if, and we didn't, but if we negotiated employee contributions, then everybody would have to pay the same amount. So the way that this is structured, hope I'm saying that right, Damien, is that only county contributions go into it. 401ks, 457s, those are voluntary contributions by the participant. Sometimes there are matches, but in this case, just the HRA, the way that it was structured was employer-only contributions. Is the Salvador, good to see you. Is the Board of Supervisors voting on this issue on December the 20th? So Salvador, as long as we advise the county that a unit or all 6 units have ratified, then they will adopt this tentative or consider adopting this tentative agreement at the Board of Supervisors meeting on the 20th. So yes. Please, what is our time frame to focus on freeze or cash out? Is it the time in question or what we have already served, or is it the time we served plus moving forward? And what is the length of this agreement? Okay, that's Maria. There's a lot to unpack there. So the length of this agreement is this negotiation was outside of our current or our upcoming negotiations, meaning that this tentative agreement will be incorporated into our current MOUs, which means that our current MOUs expire the end of June. The time in question, when it's time for you to decide freezing or cashing out, will be your full years of service as of June 16th, 2023. So let's say that you're in the portal and your hire date is May the 1st, and you're in the portal in March or April, and it's giving you X number of years of full service or full years of service. That it may be tweaked because you have a hire date before June 16th, and it will likely alert you that you have another full year of service coming before the transition. I haven't personally seen it, but what they describe is it will show you at the time you're in it, live in it, how many full years of service you have. And you may need to consider if you're going to roll into, based on your hire date, another full year of service. But that amount, whether it's frozen or cashed out and rolled over, will be as of June the 16th, 2023. Is there a VIP tool already active? No, they're in fact building another one. OCEA is in the process of building it. The county has an interest in starting the education as soon as possible after December 20th, but there's a lot that's going to go into that transition. As soon as we get our eyes on it, then we'll be working with it and hopefully educating our members to the extent that we can, but it is not available at the moment. For funds to be spent from the IRA, do the members need to submit a claim, or is there a plastic debit card? Great question. As you know, like flexible spending, some use a debit card. ICMA for HRA reimbursement does not, which means that all of your eligible expenses, premiums, deductibles, co-pays, vision, dental, pharmacy, will need to be submitted, I'm going to say unfortunately, in paper form, and their standard turnaround is about 10 days. You are welcome, Maria Lopez. And Salvador also, if this gets ratified, will come in effect until June 13th, 2022. No. If this gets ratified, the vacation component, Salvador, are effective immediately. The effective date of the transition is June the 16th, 2023. How is this a change? How is this a change in the interest of the county? Is there any benefit to their bottom line? So the county has been moving towards HRAs with other unions. In negotiations, they proposed a very, very meager contribution for us, and it was unacceptable. And we started examining alternatives to the retiree medical grant because know that it doesn't work for a lot of people. So because of the familiarity with the HRA and the portability of it, the flexibility of it, we felt like this was a great vehicle for accumulating wealth. Now, does it benefit the county? Over time, it will, because today the county has to account for all of the post-employment liabilities that are on the books that derives from the grant. There are assets, and then there's liabilities. You've all heard the phrase unfunded liabilities. So the county continues to have to state those post-employment liabilities on their books. It's a government rule. People who transition out of the grant and into an HRA, that's your money. That's your account. You control it. you have the ability to take it with you. There are no post-employment liabilities with an HRA. So yes, over time, that does help the county, but it also helps the employees because again, 20% or more don't use it, and now 100% are going to use it as long as people, achieve 1 year of service. Okay, just curious how the 855 number was determined. All right, so today, the amount of assets in the grant for OCEA members, just aggregate that, and it's a big number. You divide that asset by the number of years of service of all of the OCEA participants, that's how you get to 855 a year. So in essence, and now this is an extreme, if every single OCEA represented participant cashed out, then it would take that number down to 0, right? Because all that money would be going into your accounts. So not everyone is going to make that decision. Some will choose to freeze the grant because it makes sense to them. But that's how the 855 was determined. What are the actuarial projections? But stay till June. How long will it take for me to get my cash from the HRA? Oh, I mixed up too. Sorry. What are the actuarial projections for insurance increase over the next 10 years? The county is offering 2.5% increase. Okay, these are apples and oranges to an extent. So let me start by saying the reason that we want the May timeframe for transition is because we are anticipating having the 2024 retiree health plan premiums public in May. Usually they come out in July. We are pushing the county to publish those rates in May. Some of you may know that the county is pursuing restructuring the active and retiree rates. There's an RFP on the street right now. We are anticipating and we are hopeful that retiree premium rates will be reduced. But we're not going to know that. You're not going to know that until May or so of 2023. So knowing the rates puts you in a better position to make that decision of freezing and using the money for county plans or not. If anybody could project what insurance increases over the next 10 years were going to be, I'd say God bless you and good luck, because you are going to make a lot of money somewhere in your life. As you know, whether you're in an HMO environment or PPO environment, it goes up, it goes down from year to year based on utilization. It is, of course, a positive trend over the last 20 or 30 years. So balancing what your age, when you retire, what kind of plan you want, how you use healthcare dollars. Do you even use healthcare dollars? Are you going before Medicare, after Medicare? Do you have pharmacy needs? And again, how long are you planning to live? All of those variables factor into these kinds of questions. Now, what is certain at this point is the county will be increasing your contribution 2.5% a year in perpetuity. Okay, next question. If you plan to retire in March, but stay till June, how long will it take for me to get my cash from the HRA? So people who are contemplating retiring but staying, right? One of the first calculations is value of the COLA versus potential HRA flexibility after the effective date. I don't know the answer of how long it'll take to get cash from the HRA, except day one, you're vested. If you leave service immediately, as soon as you have out-of-pocket expenses, then you can submit for reimbursement out of your HRA account. So I don't want to sound too hyperbolic, like, oh, the very second you leave service. But the key is you would have to leave service and then incur out-of-pocket expenses, then submit for reimbursement. Can the Board of Supervisors take away this non-vested perk? The grant is non-vested. Your HRA account will be 100% vested, your money. So the answer to the HRA is no. Once it's in your account, whether it's the 855 credit or the future contributions, as soon as it's in your account, it's in your account. You control it. Okay, my understanding is that under the RMG, you have to take the health insurance benefits at the time of retirement. If one chooses to leave county before retirement age, can you use the health care benefit years later? So that was true until January 1st of 2022. Prior to 1/1 of 22, you had to leave service, immediately retire, immediately apply for the grant, and only apply the grant to a county retiree health plan. Beginning in January of 22, you had a choice, and that choice was to do what I just described or temporarily opt out of enrolling in a county plan, temporarily not take the grant, but preserve your ability during an open enrollment or a qualifying life event to then access your grant money. Will there be an opportunity to have an automatic withdrawal of a regular health premium, or will you need to apply with paperwork for every health insurance premium payment? So my understanding is your HRA is not linked to anything, which means if you're in covered California, you might even live in a different country, not even in the United States, but you have this money. And so you have the ability, once you expend in the form of a eligible expense out of pocket, deductibles, premiums, co-pays, etc., then you can apply for reimbursement. I don't believe the HRA is linked in any kind of automatic withdrawal for a premium. Question, will I be able to change my election yearly, or is my election permanent? It depends on what election you're talking about. If you're talking about your one-time irrevocable election to freeze or cash out, that's a one-time choice, and then you're done. If you're talking about investment elections within your HRA, then you have choices. Similar to 401ks and 457s, you can mix up your investment choices as you see fit. It's self-directed. Lastly, if ratified, I can retire on June 16th, 2023 and be eligible. Okay, so you're gonna have to make a choice prior to June 16th or 2023. That choice, which you would have already made, is freeze or fully roll over into HRA. So you're going to make that choice regardless of when you retire. When a question like this comes up on a specific date, I always say, don't do that. I'm not telling you not to retire on that date, but don't do that. Wait another week because you want to make a very clear choice on how your retirement, and you're going to know that before the effective date. What will be the investment choices? Again, you're going to have a suite. There's 8 to 10 of them, everything from stable value funds to stock funds, mutual funds, different equity balanced funds. You will see them. You can probably go to ICMA and likely see what funds they offer overall. If you want to email me, cbarfield@ocea.org. I've gotten a chart from the county, and I'm more than happy to send that to you, which is currently the investment choices that they offer. But again, it's a variety. So as Kevin is putting my email address in there, again, we trust that this is complicated stuff. Some of you may have never thought about the grant, and now all of a sudden you have choices. And yes, they are big time important choices, which is why we wanted to create a choice and not simply have a new plan come into existence. It's important to our members to have a choice in something like this. Last question, what is the default? If you don't make a choice, you're frozen in the grant. Okay, so the default to not taking an action is you get frozen in the grant. So please, as these things first need consideration for ratification, please let us know how we can continue to answer those questions. Hit us up at OCEA. We've got plenty of staff that is committed to answering questions. If you want to go through this again, tomorrow at noon, from noon to 1, we'll go back through it. Again, access all the resources. And I'll go back to the question of, why are you forcing me to vote the next day? We're not forcing anybody to vote the next day. You've got an 8-day window built off of a week's worth of education in order to make this important decision. We know that. So if any of you have any ongoing concerns or questions, please hit us up. We want you to be as informed as possible. So again, first of all, thank you for taking the time, for being engaged, being involved, and jumping in for to be more educated on this. Again, if you have any questions regarding timeframes or individual content, just hit us up in the office and we'll walk through it with you. Okay, so on behalf of OCEA staff and our board of directors, again, thank you for taking the time to join us. This is an important matter. It's an important decision. We are hopeful going into Christmas that we deliver for our thousands of members a superior benefit right before Christmas. But again, it's members' choice. So be informed, be involved, be engaged in your union. Thank you very much. Good night, everyone, and appreciate the time and the questions. That was enjoyable. Take care, everybody. Thank you.